Good morning from rainy and cool Chicago, where the 3-2 Chicago Bears will face the New Orleans Saints at Soldier Field in just about 2 hours. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, October 19th, 2025. In today's podcast, our focus is on last week's stall in the benchmark S&P 500's bullish April trend amid a negative shift in some of our data-driven models. The S&P 500 has risen by an incredible 40% over just the past 6 months, and thus is vulnerable to at least a significant corrective decline from here. We're going to look at what our models are saying about the current health of the market and also where the money is going as we head into next week. Before we get started looking at the latest charts, data, and the updated models that we track here at Asbury Research, here's a little bit of info about us. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005, which makes this our 21st year in business. We have 2 levels of research service available. Our flagship, Asbury Premium, which is what we launched the business with in 2005. It's for more serious investors, includes all the latest updates on all of our models, on all of our ETF picks, and some personal instruction via Zoom on how to implement all of these into your own portfolio. We also have an entry-level Substack newsletter. Here it is here, asburyresearch.substack.com. It's a kind of a short version for those that maybe are just starting to get to know us, want to get to know us a little better. It's $25 a month. It does not include all of our trading models, but it offers some selected reports and excerpts from the premium research product. There's also a free version of the Substack. So if you follow us on YouTube, if you've been following us around the internet, the various interviews that they do with us, this is a kind of a no-brainer. It's a great way to get more stuff from us, more information, more examples of how we look at markets. Again, it's a no-brainer. Just go to asburyresearch.substack.com, sign up for the free version. There's a model in there. It's called the SORT report. You see it here. We're going to go through it in just a little bit, explain to you how we use that to go through a lot of markets, a lot of data, and quickly find out where the opportunities are. Let's go back here to the landing page. So this is asburyresearch.com. If you have any questions about anything that we're talking about today, you go to the contact tab here and reach out to us and we will respond. Individual investors, financial advisors, and RIAs can also access Asbury Research's models via the managed accounts that are available either through Charles Schwab or through a TAMP. A TAMP is a turnkey asset management platform, for those that don't know. We have created 4 different model portfolios: Asbury Aggressive, Asbury Balance, Asbury Conservative, and Asbury Ultra Conservative. These 4 all use our models as building blocks: the CPM, the CEF model, some of the other models that you've seen if you've been following us along. If you've ever seen the movie Moneyball, about how Oakland A's general manager Billy Beane built a baseball lineup using quantitative metrics, finding players nobody else would have found, and changed baseball forever. This is what we try to do with the financial markets. We've built a lot of models, a lot of techniques, a lot of strategies, and what we do is we insert these into a lineup, so to speak, to try to get a desired result, either having tiny drawdowns or being more aggressive. So as we assemble these as baseball players in a lineup, it allows us to build some pretty robust strategies that implement a lot of tools. 3 or 4 of these model portfolios year to date have significantly outperformed the S&P 500, all of them with lower maximum drawdowns, lower standard deviations, lower betas, and higher Sharpe ratios. Our ultra-conservative model is trailing the S&P 500 by about 2.3%, the only one that isn't outperforming, but the maximum drawdown on this very defensive model is only 6%, compared to the 19% drawdown in the S&P that we had earlier this year. So if you're an older, very risk-averse investor, this model might be a great way to pursue getting a better yield than you're going to get with short-term treasuries right now, which is a little bit under 4%, but without the risk of being in the S&P 500 and having to weather a 19% drawdown. Anyway, contact us via the contact tab here to request more information about any of this stuff, and we will be happy to reach out to you. We could do a Zoom meeting for more information. So let's get started on the good stuff here. The first place we're going to go is we're going to go to the Research Center. This is the paywall, and we're going to go to the Correction Protection Model, or CPM. It's the first model that we built. It's at least 10 years old. And what this is a risk-on and risk-off model. We are risk-off as of October the 10th. So this is since the last time that I've seen you. This is a new signal. Here's what our signals look like going back to October of 2023, or 2 years. You can see we had been risk-on since April the 24th, and we are now risk-off. What is CPM? CPM is a completely data-driven dynamic stocks bonds allocation model. It was designed to be an alternative to the standard 60-40 portfolio that if you have ever used an advisor, you're probably very familiar with that. It's kind of set it and forget it. That never made any sense to me. The market should be telling us whether we should be in stocks or bonds, and not somebody in a suit that had a meeting with us 3 years ago. Let's just change views here real quick. This is our CPM model versus AOR. What AOR is an ETF. It's the ticker for an ETF that tracks a 60-40 portfolio. AOR is in blue, CPM is in green. So just picture says 1,000 words, right? This is one reason that we should be using the market to tell us when to be in or out, and not a set it and forget it type of an allocation, which may not help us if the market changes direction or if the inputs in the market change. If the market starts to look more at something different that maybe was not part of the picture when that 60-40 portfolio was allocated. Let's go back to where we were, to the CPM. And what it does, it's designed to protect investor assets during market declines. Eliminate the large drawdowns. Maximum drawdown, again, in the CPM this year was 9% compared to 19% for the S&P 500. It reduces volatility. Your standard deviation is lower. Your beta is lower. It works by moving assets out of the market and into a short-term T-bill when the market tells us we're in a risk-off situation, as we are now. Again, CPM is a relative performer year-to-date, but with less than half the maximum drawdown, 6.7% lower standard deviation, and a 50% lower beta than the S&P 500. When we talk about standard deviation, it indicates smaller price swings and a narrower range of possible returns, implying a more consistent return and lower risk. When we talk about beta, a strategy with a lower beta suggests a more stable investment as it's less volatile than the overall market, which is typically the S&P 500. Here's our drawdowns. Here's why drawdowns are so important and why we talk about them so much. A lot of this has to do with my age. I am in my 60s, and you've probably seen my son Jack. I've spoken about him. He's my partner. He's kind of the math end of the business. Once you get to be my age, the game changes. It's like playing football in the fourth quarter. If you have a lead, you're not throwing the ball up in the air anymore. You're not handling the ball a lot. You're giving it to your big fullback and let him eat the clock out and score as much as you can, but do it safer. This is where we're going here. I wanted to show you these drawdown slides. This is just the mathematical representation of what happens in a drawdown. If you draw down 10%, you have to make 11% back the other way in order to break even. That's not a big deal. But if you have a 30% drawdown, we had a 34% drawdown during the COVID period. That was the early part of 2020. You had to make 43% back the other way. Keep in mind that we're up 40% in 6 months. There's going to be a pullback at the very least, and we don't want to be caught in a situation where we take a 30% drawdown and maybe we're taking RMDs, or maybe we're going to start to take RMDs soon, and now you're drawing down even more. These drawdowns can change how you retire and how long your money lasts. Here's a second example here. This is CPM yearly drawdowns versus SPY going back to 2018. Again, sometimes the drawdowns are not that big. It all depends on the year. But here's the COVID year. COVID drew down 33.9%. The S&P 500 only drew down 9%. It's a big deal. It took us a lot less time to get back because we didn't take such a big hit on the way down. This is this year. I had mentioned it. S&P drew down 18.9%, and CPM only drew down 9.3%. So that's why this is so important to us, is protecting yourself on the way down. It lets you get back to where you were faster. And again, it doesn't complicate things or compromise how long your money lasts if you're going into retirement. Let's move back and take a look at our SEAF model. Our SEAF model is our sector rotation model. So we're going to go back to the Research Center. Again, this is the paywall, and we're going to go to SEAF. SEAF is an acronym. It stands for Sector ETF Asset Flows. And the purpose of SEAF, unlike CPM, SEAF model is always fully invested in the market. It's providing investors with a dynamic alternative to the traditional buy and hold part of a portfolio. Most people that I've spoken to, most managers, there's a chunk of money that always stays in the market. Rather than putting it in the S&P 500 or putting it in the S&P 1500 or some kind of a vanilla place to park that money, what we've done here is we've built a model that calculates through an algorithm we built how fast the money is moving around these 11 sector spiders, which if you put them together, it's the S&P 500. We have a scoring system. It's like golf. The higher the score, the worse you're doing, the better the score, the more desirable. So what you see here is that this week, our top three, based on 3 different time frames, trading, tactical, and strategic, which is a week, a month, and a quarter. We've got utilities, technology, and communication services are where the money is moving into the fastest. It's moving out of the fastest, energy, financials, and industrials. So SEAF has outperformed the S&P 500 by about 3% year to date, with a 3.5% lower maximum drawdown and a 2.9% lower standard deviation and about 25% lower beta. Since inception in 2018, SEAF has significantly outperformed the S&P 500 on an annualized basis, with better risk-adjusted numbers like Sharpe ratio and others. Here's how SEAF is done versus his peers. We're going to change views on you again. And this is hypothetically back-tested. SEAF is hypothetically back-tested. The These others we're going to show our actual performance, so it's not a perfect match. We just use it as a measure to see how well our strategies are doing versus other similar strategies that are out there in the marketplace. So CEF is green, and then there's three others here. And you can see starting at 219 through 2025. Got a small lead here in 2025. We were second, let's call it, just off the leader in 2024. We were the leader in 23. We led in 22. We led by a lot in 2021, and some of these weren't around in 2020 and 2019. So not to linger there, but this is CEF has been outperforming its peers for some time, and it's been able to do it with lower risk, which is, again, the most important to us. Let's shift gears and take a look at our Asbury 6. Most of you are familiar with the Asbury 6 if you've seen me on Schwab Network or during Fidelity, some of the educational webinars that I've done there. The Asbury 6 is our daily driven gauge. Let's get over there so we can look at it while I'm talking. Again, it's right at the top of the research center. And there's the A6. It's a daily driven gauge of the U.S. stock market's real internal health according to 6 diverse market metrics, which we selected via quantitative backtesting. We've got stuff in there like asset flows, like market breadth, like volatility. Every individual indicator has an Achilles heel. We really built this for two reasons. The primary reason is there's a lot of volatility in the S&P 500 that didn't used to be there 10 years ago. Last week was kind of a poster boy for that. I think we had 3 or 4 days last week, maybe 3, that had a 100-point range, where the S&P was maybe up 80 in the morning and down 30 in the afternoon. So it became increasingly difficult for me, that's been doing this all my life, to try to look at the S&P 500, a chart of the S&P 500, and like volume or a stochastic or something of that nature, and make a accurate determination of what the health of the market was. So we built this tool. All 6 of these indicators are very different from each other, and every indicator has an Achilles heel, like I started to say. None of them work all the time. So what we did is we took the indicators that were the most useful to me throughout my time in the markets, which is 40 years plus now, try to take the ones that worked well for me, that I understood well, and I was able to do well with them throughout my career when I was on the trading floor. And when I got off the trading floor, we started to back test them in different groups of 3, groups of 4. And we found 6 that worked really well together in terms of being able to pick each other up. If one of them wasn't working well for a certain period of time, they are different enough from each other that they work really well as a team. Again, it's made to be an indicator rather than a model. 4 or more of these in green means the model is positive. It's bullish. 4 or more are red, it's negative or bearish. You can see 4 are red now heading into next week. This is what the model looks on a chart. It's a lot more active. The CPM round turns about 5 per year annualized, going back 8 years. This is about 10. It's twice as active, but I want this to be an EKG of the market. This really helps us to not only identify the tops and the bottoms, which it's done a pretty good job at, but also let us know when the market is in transition. Look at these quick signals back and forth since the end of September. The market isn't quite sure of what to do, and that indecision often turns into a market top. So with that, let's shift gears and look at some charts that we think are particularly important to pay attention to next week. This is our keys to this week. This is our weekly comprehensive look at what we think is important. We probably look at 100 charts and we pick out 10 that we think are the most germane and the most influential for the upcoming week. So we've got April advances at a tactical decision point. It's leaning lower, and we're going to show you why. Before we do that, let's look at where the support is. This is chart 1. and this is the S&P 500, and we've got two lows and a 50-day moving average in between 65.69 and 65.51. This is where what we call primary tactical support is. As long as it holds, the minor uptrend is still intact. If we break that, the next level is 3% lower at right around 63.50. I'm circling it right here with my mouse. So that's the level to watch. Watch 65.50 next week. If it breaks through there, we can see a pretty quick extra 3% move down to the 63.50 area. Next chart we want to look at is chart 4 on this report. This chart on top with the blue line is the relative performance of SPY, which is the S&P 500, versus TLT, which is the price of a long-term treasury bond. TLT is the ticker. We've got a 63-day moving average here in green. We want to identify what the quarterly trend is of either outperformance or underperformance. And what you can see since April 22nd, which is roughly, that's right around where the CPM went back to risk on. The S&P 500 has been doing well since then because stocks are outperforming bonds. You can see we had a test on August the 1st. That was a nice little bottom in the S&P. We had another test on September the 8th. That was another place where you could put on some new longs. Look what's happening now. Since October 10th, stocks are slowly underperforming bonds on a 63-day basis. It's the beginning of a trend, but it's there. I think it's something to pay attention to. The next one we're going to look at is volatility. We've got the VXX here, which the VXX is the futures version of the VIX. Note that it's becoming elevated by its 21-day moving average. Why 21 days this time? Because this is a tactical tool for us, and 21 days is our tactical time period. 63 days is our strategic time period. When you're looking at indicators, you need to know what your time period is and what you're trying to do. Is it the trend you're trying to catch, or is it the tactical time period that you're negotiating in and out of that trend? So the fact that the VIX and VXX have been elevated all last week tells me the market's getting a little bit nervous on a near-term standpoint. That could be a problem. The last one we're going to look at is a little bit abstract, but I think it's a really important chart. SPDW is the Spider Portfolio Developed World ex-US ETF. In English, what that means is this is global equities, developed markets without the S&P 500 included. And what we're seeing is from February to June of this year, it was outperforming the S&P 500. What happened during that period? For a lot of it, the S&P went down. All right. And then it's been underperforming since June 17th to about a week ago. That was a strong period for the S&P 500. As of the end of last week, SPDW is starting to outperform SPY again. If this continues, that's likely going to coincide with a move lower in the market. And more importantly, it's going to tell us that we have another model that we're not going to have time to show you today. It's called US versus the world. And it looks at 25 non-US equity markets. If we start outperforming here, the S&P starts moving lower, that model will identify which parts of the world that we want to overweight. So while the S&P is taking a rest, we can be making some outperformance in other parts of the world. Our final part that we're going to look at today, and this is another part of the premium service, is our Asbury ETF trade ideas. So the last time I was with you 2 weeks ago, I think we looked at some of these. We took profits on a couple. We were in Palladium as of October the 6th. We exited that trade. PALL was a ticker. On Friday, we made 13% outright, outperformed the S&P by 18%. Our metals and mining, XME, which we had put on August 28th, we also were stopped out of that for a 27% profit. outperforming the S&P by 26%. We are still overweight Ring, RANG, and we're also overweight GDX, which is another gold miners. Let's jump over and have a look at Ring. So this is Ring, and we bought Ring right here on August the 6th. And to date, you've got a nice lead here of about 35-36%. The important part for me is we've outperformed the S&P. The S&P's had a good period as well from August, but we've managed to outperform the S&P here by 30%. So that's really important to us to make sure we outperform. To me, I'm not buying a commodity unless it's outperforming the S&P 500. You can buy SPY for free, right? It's very cost effective, and you could buy and hold and cross your fingers. So whenever we're putting these ideas on, a big goal of ours is that they outperform the S&P. So if we go back here, we've been making these for 2.5 years, and we've got kind of three legs of a stool. Positive price trends. It needs to be outperforming the S&P. It needs to be have expanding AUM. There's money going into that ETF. And the fourth part is subjective. This is based on my experience of doing this for a while. We look for attractive risk-reward ratios. So over time, over the past 2.5 years, we've had 111 trades. And our maximum drawdown is only 2.8%. 54% of these have made money. Average winning trade is 5.4%. Average losing trade is 2.4%. We've been in our winning trades for about 18 days, which is just a little less than a business month. And our losing trades, which are only 2.4%, we were only in for 8 trading days, which is about a week and a half. So our ratio of winning trades to losing trades is 2.3 to 1. The reason I mention this is because this is the recipe for a successful and repeatable way to either pick stocks or pick ETFs. We pick ETFs here, but you need to have more winners than losers. And your winners need to be larger than your losers. And if you can do that consistently over time, these are the important ingredients to having an important systematic trading that you can carry forward. Keep your drawdowns low so you stay in the game and still be able to make money over time. The Asbury 6, the CPM model, and the CEF model and the trade ideas are all a part of Asbury Research's premium research service. For more information about that, if you want information about pricing, again, you can contact us here via the contact tab. Finally, let's take a look at our sort report. I mentioned the sort report. This is part of the Substack service, part of the entry-level Substack online newsletter. It's called Asbury Research's Chart Focus. One of the research pieces that you're going to get there is our sort report. Again, the service is $25 a month. It's kind of an entry-level version to Asbury Research and what we do here. And there's a Substack link below this video that you can click to sign up if you want the free version. The sort report. It started out as an internal indicator for us. It tells us which parts of the global market have positive trends. Let's make this a little bit bigger. Positive trend that are relatively outperforming whatever their benchmark might be. In most cases, it's the S&P 500, and have positive asset flows, which is the money flows part here, which means there is new money that is pushing the price of that ETF higher. This is a very low-cost way to make better investment decisions based on data and not opinion or economic forecasts. Remember, forecasting is a euphemism for taking a guess. We believe that following the money is a way to go, and this helps us to do that. So there it is. This wraps up our latest Asbury Research's Following the Money podcast. Our next Following the Money is tentatively scheduled for Sunday, November the 2nd, which is 2 weeks from this afternoon. I hope to see you then. In the meantime, if you have any questions, want any info on any of the research models and model portfolios, any of the asset management that we spoke of, the best way to get us is to right here, asburyresearch.com, and use the contact tab, and we can either get on the phone with you or we can set up a Zoom. Have a wonderful Sunday. Go Bears. And don't forget to like and subscribe. We'll see you in 2 weeks.